Hello YouTubers, welcome back to my channel Scapital Investments. My name is Salman Shaikh and today we will be discussing hedging in futures trading. Yes, this is the part 5 of my video series on basics in futures trading. In case you haven't checked the first 4 videos, I recommend you to please check the link in the description. Well, this fifth part of hedging in futures trading is actually an advanced video. Well, you must have heard about hedging in options trading, but yes, hedging also occurs in futures trading. You may have a portfolio of stocks, and one of the most important and practical applications of futures is actually hedging those portfolio. In the event of an adverse movement of the market, hedging is a simple workaround to protect your positions from a huge loss. Now let me give you an analogy to help you understand what hedging in futures trading actually is.
Imagine you have a small bit of a vacant barren land just outside your house. Instead of seeing it lie vacant and barren, you decide to lawn the entire plot and plant a few nice plants. Those are flowering plants. You nurture the little garden with water and regularly you watch it grow. Eventually, your efforts pay off and the lawn grows lush green and the flowers finally start to blossom. As the plants grow and flowers start to bloom, it starts to attract attention of the wrong kind. Soon you realize your little garden has become a hot destination for a few stray cows. You notice these stray cows merrily gazing away at the grass and spoiling the nice flowers. You are really annoyed with this and decide to protect your little garden. A simple workaround is what you have in mind. You erect a fence, maybe a wooden hedge, around the garden to prevent the cows from entering your garden. This little workaround ensures your garden stays protected and also lets your garden flourish.
Well, now let us correlate this analogy to the markets.
Imagine you nurture a portfolio by picking each stock after careful analysis. Slowly, you invest a sizable corpus in your portfolio. This is equivalent to the garden you grow. At some point, after your money is invested in the markets, you realize that the market may soon enter a turbulent phase, which will result in a portfolio losses. This is equivalent to the stray cow grazing your lawn and spoiling your flower plants. To prevent your market positions from losing money, you construct a portfolio hedge by employing futures. This is equivalent to erecting a fence wooden hedge around your garden.
I hope this analogy gives you a fair sense of what hedging in futures trading actually is. Like I mentioned earlier, hedging is a technique to ensure your position in the market is not affected by any adverse movements. Please don't be under the impression that hedging is done only to protect a portfolio of stocks. In fact, you can deploy hedging strategies with futures to hedge the individual stocks, although there will be some restrictions definitely. But why to hedge?
A common question that gets asked frequently when one discusses hedging is why really hedge a position? Imagine this, a trader or an investor has a stock which he has purchased for rupees 100. Now he feels that the market is likely to decline and so would his stock. Given this, he can choose to do one of the following. He can either take no action and let his stock decline with the hope it will eventually bounce back. Second option is to sell the stock and hope to buy it back later at a lower price. And the third is to hedge the position. Firstly, let us understand what really happens when the trader decides not to hedge. Imagine the stock you invested declines from rupees 100 to let us say rupees 75. We will also assume eventually as time passes by, the stock will bounce back to rupees 100. So the point here is when the stock eventually moves back to its original price, why should one really hedge? Well, you would agree the drop from 100 to 75 is a 25% drop. However, when the stock has to move back from 75 to 100, it is no longer a scale back of 25%. Instead, it works out to that the stock has moved to 33% to reach the original investment value. This means when the stock drops, it takes less effort to do so, but it requires extra efforts to scale back to the original value. Also, from my experience, I can tell you stocks do not really go up that easily unless it's a raging bull market. Hence, for this reason, whenever one anticipates a reasonably massive adverse movement in the market, it is always prudent to hedge the positions. But what about the second option? When the second option, where the investor sells the position, and buys back the same at a later stage requires one to time the market, which is not something easy to do. Besides, when the trader transacts frequently, he will also not get the benefit of long-term capital tax. Needless to say, frequent transactions also incurs additional transactional fees. For all these reasons, hedging makes sense as it is virtually insulates the position in the market and therefore becomes indifferent to what really happens in the market. It is like taking a vaccine shot against a virus. Hence, when the trader hedges, he can be rest assured the adverse movement in the market will not affect his position.
Before we can proceed to understand how we can hedge a position in the actual market, I guess it is important to understand why we are actually hedging. Well, you must have understood by now that we are trying to minimize the risk. But why to hedge this risk?
When you buy the stock of a company, you essentially exposed to risk. In fact, there are two types of risks, that is systematic risk and unsystematic risk. When you buy a stock or a stock future, you are automatically exposed to both these risks. The stock can decline, resulting in losses for you for many reasons. Reasons such as declining revenues or declining profit margins, higher financing costs or higher leverage, or management misconduct. All these reasons represent a form of risk. In fact, there could be many other similar reasons, and this list can go on. However, if you notice, there is one thing common in all these risks. They are all company specific risks. For example, imagine you have an investable capital of rupees 1 lakh. You decide to invest this money in HCL Technologies. Now, after a few months later, HCL made a statement that their revenues have declined. Quite obviously, HCL stock price will decline as well, which means you will lose money on your investment. However, this news will not impact HCL's competitors, that is Tech Mahindra or Mindtree's stock prices. Likewise, if the management is guilty of any misconduct, then Tech Mahindra's stock price will go down and not its competitors. Clearly, these risks, which are specific to the company, affect only the company in the question and not others. Such risks are often called the unsystematic risk. Unsystematic risk can be diversified, meaning instead of investing all the money in one company, you can choose to diversify and invest in 2 to 3 different companies, preferably from different sectors as well. When you do so, unsystematic risk is drastically reduced. Imagine you, instead of buying HCL for the entire capital, you decide to buy HCL for 50,000 and maybe Karnataka Bank Limited for other 50,000. Under such a circumstance, even if HCL stock prices declines owing to unsystematic risk, the damage is only on half of the investment as the other half is invested in a different company. In fact, instead of just 2 stocks, you can have a 5 stock or 10 or maybe 20 stock portfolio. The higher the number of stocks in your portfolio, higher the diversification and therefore lesser the unsystematic risk. This leads us to a very important question. How many stocks should a good portfolio have so that unsystematic risk is completely diversified? Research shows that up to 21 stocks in the portfolio will have the required necessary diversification effect, and anything beyond 21 stocks may not help much in diversification. Now I'll just show you a systematic versus unsystematic risk defined graph. As you notice from the graph, the unsystematic risk drastically reduces when you diversify and add more stocks. However, after about 20 stocks, the unsystematic risk is not really diversifiable. This is evident as the graph starts to flatten out after 20 stocks. In fact, the risk that remains even after diversification is called the systematic risk. A systematic risk is the risk that is common to all stocks. These are usually the macroeconomic risks which tend to affect the whole market. Examples of systematic risks include degrowth in GDP, interest rate tightening, inflation, fiscal deficit, or geopolitical risk. Of course, the list can go on, but I suppose you got a fair idea of what constitutes systematic risk. Systematic risk affects all stocks. So, assuming you have a well diversified 20 stock portfolio, a degrowth in GDP will affect certainly all the 20 stocks and hence they are all likely to decline. Systematic risk is inherent in the system and it cannot really be diversified. However, systematic risk can be hedged. So when we are talking about hedging, do bear in mind that it is not the same as diversification. Remember, we diversify to minimize unsystematic risk and we hedge to minimize systematic risk.
Understand? Now let us understand hedging of a single stock position. Now we will talk first about hedging a single stock position because it's straightforward and very simple and easy to understand. We will also understand its limitations and then try to move on to understanding the hedging in a portfolio of stocks.
Now let's take a hypothetical example of Infosys shares where you bought a 250 shares of Infosys at 2284 per share. Now this works out to an investment of rupees 5,71,000. Clearly, you are long on Infosys in the spot market. After you initiated this position, you realize the quarterly results are expected soon. You are worried Infosys may announce a not so favorable set of numbers, as a result of which the stock price may decline considerably. To avoid making a loss in the spot market, you decide to hedge the position. In order to hedge the position in the spot, we simply have to enter a counter position in the futures market. Since the position in the spot is long, we have to short the futures market. In case you are not so comfortable in shorting, I recommend you go and check my previous video on shorting in futures market. That will help you give confidence in understanding this topic. So here are the short future trade details. So you short futures of Infosys at 2285 with a lot size assuming to be 250 and the contract value of 5,71,250. Now on one hand you are long on Infosys in the spot market and on the other hand we are short on Infosys in the futures market, although at different prices. However, the variation in price is not of concern as directionally we are neutral. You will shortly understand what this means. After initiating this trade, let us arbitrarily imagine different price points for Infosys and see what will be overall impact on the positions. So here is the arbitrary price, the long spot PNL, short futures PNL and the net PNL. Here the arbitrary price chosen are 2200, 2290 and 2500. The point to note here is irrespective of where the price is headed, whether it increases or decreases, the position will neither make money nor lose money. It is as if the overall position is frozen. In fact, the position becomes indifferent to the market, which is why we say when a position is hedged, it stays neutral to the overall market condition. As I had mentioned earlier, hedging single stock positions is very straightforward with no complications. We can use the stock's futures contract to hedge the position. But to use the stock's futures position, one must have the same number of shares as that of the lot size. If they vary, the PNL will vary and the position will no longer be perfectly hedged. This leads to a few important questions. What if a position in the stock that does not have a futures contract, for example, South Indian Bank does not have a futures contract? Does that mean I cannot hedge a position in South Indian Bank? The second question here is, the example considered the spot position value was 5,70,000, but what if I have a relatively small position, say around 50,000 rupees or even 1 lakh rupees? Is it possible to hedge such positions?
In fact, the answer to both these questions is not straightforward. We will understand how and why shortly. For now, let us try to understand how we can hedge multiple stock positions, usually a portfolio. In order to do so, we need to understand first what is the beta of a stock.
Beta, denoted by the Greek symbol beta, plays a very crucial concept in market finance as it finds its application in multiple aspects of market finance. I guess we are at a good stage to introduce beta as it also finds its application in hedging portfolio of stocks. In plain words, beta measures the sensitivity of the stock price with respect to the changes in the market, which means it helps us answer these questions. If market moves up by 2% tomorrow, what is the likely movement of stock XYZ? How risky or volatile is stock XYZ compared to market indices Nifty or Sensex? Third, how risky is stock XYZ compared to stock ABC? So the beta of a stock can take any value greater or lower than 0. However, the beta of the market indices, that is Sensex or Nifty, is always 1. Now for example, assume beta of BPCL is plus 0.7. The following things are implied. First, for every 1% increase in the market, BPCL is expected to move up by 1%. So if the market moves up by 1.5%, BPCL is expected to move up by 1.05% only. And if the market decreases by 1%, then BPCL is expected to decline by 0.7%. Because BPCL's beta is less than the market beta, 0.7% versus 1% by 0.3%. 0.7% by 1%, that is a 0.3% difference is there between the beta of BPCL versus the beta of market. So it is believed that BPCL is 30% less risky than markets. One can even say BPCL relatively carries less systematic risk. Assuming HPCL's beta is 0.85%, then BPCL is believed to be less volatile compared to HPCL, therefore less risky. So you can see the table to get a perspective on how to interpret beta value for the stock. And all these are available on Google freely. So if you search for beta of stock, you will find all the stock betas. A point to note is that when the beta is negative, that means the stock in discussion actually moves against the market. So wherever the market moves up, the stocks with negative beta actually move down and vice versa.
Let's discuss the topic hedging of a portfolio. So we will focus on hedging a portfolio of stocks deploying Nifty Futures. However, you may have a question, why to use Nifty Futures to hedge a portfolio of stocks? And why not something else?
Do recall there are two types of risk, systematic risk and unsystematic risk. When we have a diversified portfolio, we are naturally minimizing the unsystematic risk. What is left after this is the systematic risk. As we know, systematic risk is the risk associated with the market. Hence, the best way to insulate against market risk is by employing an index which represents the market. Hence, the Nifty Futures come as a natural choice to hedge the systematic risk. Assume I have 8 lakh rupees invested across the following stocks as shown in the table: ACC Limited, Axis Bank Limited, BPCL, Cipla, DLF, Infosys, L&T, Maruti Suzuki. So this comprises of total 8 lakh portfolio of stocks. Now let us first calculate the portfolio beta as a step 1. There are few steps involved in hedging a stock portfolio. As the first step, we need to calculate the overall portfolio beta. The portfolio beta is the sum of the weighted beta of each stock. Weighted beta is calculated by multiplying the individual stock beta with their respective weightage in the portfolio. Weightage of each stock in the portfolio is calculated by dividing the sum invested in each stock by the total portfolio value. For example, let us see the weightage of Axis Bank. So here 1,25,000 divided by 8 lakh is equal to 15.6%. Hence, the weighted beta of Axis Bank in the portfolio would be 15.6% multiplied by the beta of Axis Bank, 15.6 into 1.4, that is 0.21. So I have mentioned the calculation of weighted beta of each stock in the portfolio in this tabular format. The beta values as usual can be obtained from internet easily. The sum of the weighted beta is the overall portfolio beta, and for the portfolio under consideration, the beta happens to be 1.223. This means if Nifty goes up by 1%, the portfolio as a whole is expected to go up by 1.223%. Likewise, if Nifty goes down by 1%, then the portfolio is expected to go down by 1.223%. Let us calculate the hedge value. The hedge value is simply the product of the portfolio beta and the total portfolio investment. 1.223 into 8 lakhs, that is 9,78,400. Remember, this is a long only portfolio where we have purchased these stocks in the spot market. We know in order to hedge, we need to take a counter position in the futures market. The hedge value suggests to hedge a portfolio of rupees 8 lakh, we need to short futures worth rupees 9,78,400. This should be quite intuitive as the portfolio is a high beta portfolio. The step 3 is to calculate the number of lots required. At present, Nifty Futures is trading around 17,750 And with the current lot size of 50, the contract value per lot works out to be 17,750 into 50, that is rupees 8,87,500. Hence, the number of lots that is required to short Nifty futures would be hedge value divided by the contract value, that is 9,78,400 divided by 8,87,500. So it turns out to be 1.1024. Now the calculation suggests that in order to perfectly hedge the portfolio of rupees 8 lakhs with a beta of 1.223, one needs to short 1.1 lots of Nifty futures. Clearly, we cannot short 1.1 lots as we can short either 1 or 2 lots. Fractional lot sizes are not available. If we choose to short 1 lot, we would be slightly underhedged. Likewise, if we short 2 lots, we would be overhedged. In fact, for this reason, we cannot always perfectly hedge a portfolio. Now let us assume after employing the hedge, Nifty in fact goes down by 500 points or about 2.81% from 17,750. With this, we will calculate the effectiveness of the portfolio hedge just for the purpose of illustration. I will assume we can actually short 1.1 lots. So the Nifty positions, we initiated the short at 17,750. The decline in the value of 500 points, Nifty comes down to 17,250. The number of lots we shorted is 1.1. So the PNL would be 1.1 into 50 into 500, that is 27,500. So the short position has gained 27,500 because we are shorting the market. So we will look into what could have happened to the portfolio. The portfolio position is of 8 lakhs with a portfolio beta of 1.223. With a 2.81% decline in the market, the expected decline in the portfolio is 2.81 into 1.233, that is 3.464%. So 3.464% of 8 lakhs is 27,712. Hence, you can see on one hand, Nifty short position has gained 27,500. On the other hand, the long portfolio has lost 27,712. As a net result, there is no major loss or gain. Just ignore the minor price difference in the net position in the market. There is no loss or profit from this transaction because we are positionally neutral. The loss in the portfolio is offset by the gain in the Nifty futures position. With this, I hope you are now in a position to understand how you could hedge a portfolio of stocks. I would encourage you to replace 1.1 lots by either 1 or 2 lots and run the same exercise. Finally, before we wrap up this chapter, let us revisit 2 unanswered questions that we posted when we discussed hedging single stock positions. I will reiterate the same for your convenience. What if I have a position in a stock that does not have a futures contract? For example, South Indian Bank does not have a futures contract. Does that mean I cannot hedge a spot position in South Indian Bank? In the example considered, the spot position value was rupees 5,70,000. But what if I have a relatively small positions, say rupees 50,000 or even 1 lakh? Is it possible to hedge such positions? Well, let me answer these questions for you. You can hedge stocks that do not have stock futures. For example, assume you have 5 lakhs worth of South Indian Bank. All you need to do is multiply the stock's beta with the investment value to identify the hedge value. Assuming the stock has a beta of 0.75, the hedge value would be 5 lakhs into 0.75, that is 3,75,000. Once you arrive at this directly, divide the hedge value by Nifty's contract value to estimate the number of lots required to short in the futures market. Hence, this way you can hedge the spot position safely. Here, instead of Nifty, in case of banking stock, you may also choose Bank Nifty. Now, as far as the second question goes, where your stock positions are relatively quite small as compared to the minimum number of lot size of futures available, then no, you cannot hedge small positions whose value are relatively lower than the contract value of Nifty or Bank Nifty. However, you can hedge such positions by employing options. And definitely we will discuss the options trading strategies and hedging separately. So do let me know in the comments below if you want to learn the options trading strategies and option hedging.
Well, I understand this video has been long, so let me summarize the complete topic of hedging in futures for you. Hedging allows you to insulate your market positions against any adverse movements in the market. When you hedge your loss in the spot market, then your spot market losses are actually offset by the gains in the futures market. Now, there are two types of risks. systematic risk and unsystematic risk. Now, systematic risk are actually belong to the macroeconomic events, and this systematic risk is actually common to all stocks and it can definitely be hedged. Now, unsystematic risk is associated with only a particular stock or the company. Unsystematic risk cannot be hedged, but yes, unsystematic risk can be diversified to convert it into a systematic risk. Research suggests that beyond 21 stocks, unsystematic risk cannot be diversified any further. To hedge a single stock positions in the cash market or the spot market, what we can do is take a counter position in the futures market. Beta measures the sensitivity of the stock. The market beta is always 1. The stocks that are having beta above 1 are called high beta stocks or high risk stocks. The stocks that have beta lower than 1 are called low risk stocks. The stock beta data is available on any portal for free of cost. If you can just Google it, you will find the stock beta of various stocks. To hedge a portfolio of stocks, we need to take the following steps. Step 1 is identify the beta of individual stocks. Step 2 is calculate the weightage of individual stocks in your portfolio. Then take the estimated weighted beta of each stock and then sum up this weighted beta to get the portfolio beta. Now multiply this portfolio beta with the portfolio value to get the hedge value. Now divide this hedge value by the Nifty contract value to get the number of lots. Short these required number of lots in the futures market. Remember, a perfect hedge is difficult to construct. Hence, we are forced to either use an under hedge or an over hedge. Well, that summarizes the complete topic. I hope this hedging in futures have given you a strong confidence in futures trading. You can trade into risky futures and options market and definitely earn huge returns with a minimized and a hedged risk. In case you have any queries, questions or doubts, do let me know in the comments below. I will answer to each and every one of them. I also explained to you my live trading strategies in my earlier videos, so do check out my channel and watch all those videos. So this video will conclude my futures trading series. What series do you want me to pick up next? Do let me know in the comments below. Well, that's it from my side. Thank you so much for watching. Until we meet again, Bella ciao.